Welcome to the deep dive. You gave us a massive stack of source material, the Core Outlook 2026 investment reports. And our mission today is, well, it's pretty simple. We're cutting through all that data to give you the strategic roadmap for the year ahead. We were looking at a forecast defined by a lot of turbulence. We've got sticky inflation, ongoing geopolitical volatility, and of course the massive AI revolution that's reshaping markets in real time. The analysts all seem to agree that the critical skill for investors in 2026 isn't just knowing the facts, but mastering what they're calling the interpretation game.
That's it, exactly.
Every single piece of economic data, every central bank announcement, it's going to be subject to these wild, immediate swings in market sentiment.
That's absolutely right. I mean, the difference between success and failure in 2026 is going to be understanding why the market reacted the way it did and, distinguishing the narrative from the reality. So today, we're going to break down the key financial forecasts for the major economies, the U.S., China, and Europe. And then we'll drill into the structural shifts happening in the electro-tech economy and cryptocurrencies. We want you to walk away from this knowing exactly where the risks are highest and where the durable opportunities really lie.
Okay, let's unpack this, starting with the biggest financial picture. These persistent macro headwinds that are complicating the global outlook.
So when we look at the financial environment, the theme is just minimal room for error. Equity markets globally are highly elevated, and something we watch really closely. Credit spreads are incredibly tight.
Hold on. For the listener who might not live and breathe fixed income, can you just quickly explain what tight credit spreads really means for them?
Absolutely. So the credit spread is basically the premium you get paid to hold corporate debt over safer government debt. When spreads are tight, it means the market isn't demanding much extra compensation for risk.
So it's signaling a lot of confidence.
A lot of confidence. It's signaling that investors believe there will be very few defaults, that everything is, safe. When things are this tight, it means the market is pricing in near perfection. Any negative surprise, a recession, a major geopolitical shock could cause those spreads to blow out fast.
And that would lead to major losses.
That's right, in corporate debt.
So we're stretched financially. What are the persistent challenges that are putting pressure on that already precarious position?
We see three big ones. First, government debt. Developed nations are really struggling under stubbornly high levels of public debt. And this isn't just some abstract number. The sources point out that this debt acts as a fiscal drag.
How so?
Well, the sheer amount of money being spent just on interest payments crowds out productive future investment, and it slows potential growth.
Got it. Okay, what's number two?
Second is inflation. Despite all the efforts from the Federal Reserve, inflation is still sticky. Analysts are suggesting it's probably going to persist above target right through 2026. This puts central banks in a really difficult spot. Their data dependence, their need to react to every economic print, and critically, their independence will be severely tested, especially as we head into election cycles around the world.
And the third headwind is that increasingly sort of fractured and multipolar world.
Exactly. Geopolitics is injecting a level of uncertainty into supply chains and trade flows that we just used to take for granted. We're seeing active U.S.-China decoupling and fraught domestic politics, especially in the U.S. with upcoming midterm elections. Uncertainty is the enemy of long-term capital investment, and we have an abundance of it right now.
So given all this uncertainty, what's the strategic recommendation coming out of these reports for an investor?
The answer is remarkably consistent across all the sources. Diversification is paramount to hedge against all this volatility, but the core strategy has to be focused on owning high-quality assets. They all emphasize that structurally, cash is no longer a safe alternative, with rates set to fall modestly, even if it's slowly. Cash holdings will actively erode your purchasing power relative to inflation. You just have to be thoughtful about where you put your capital.
If that's the strategy, let's turn to the equity markets, because the 2025 rally it was driven by a genuine wave of enthusiasm for technology. We saw global equities up 20% in 2025, led by tech at plus 31%.
Those numbers are staggering, but they hide a key risk: concentration. The sources confirm that the Magnificent Seven companies, which is a very, very narrow sliver of the market, contributed more than 40% of the S&P 500's total returns for the year.
Wow.
The market has rewarded concentration, and that creates fragility.
So if we strip away the enthusiasm, what was the actual mechanism driving those gains? Was it real operational success, or was it just people rushing to buy?
This is the critical distinction for 2026. The rally was driven primarily by valuation expansion, not by genuine earnings delivery. Let's make this tangible for you. Over the last 3 years, the trailing price-to-earnings multiples, which is what you're willing to pay for $1 of a company's annual earnings, jumped by 14% annually.
14%, just in the willingness to pay more year after year.
Precisely. Now, compare that to actual earnings growth corporate profits, which only rose by a modest 5% in that same period.
That's a huge gap.
The gap is enormous. The price increases came mainly from people being willing to pay much, much more for relatively slow growth.
That sounds like the market is running on pure hope or, the belief in future AI dominance rather than current financial results. What are the valuations telling us right now?
They're telling us the market is stretched. The S&P 500 is currently trading at 23 times forward earnings. That is a whopping 40% above its long-term average.
40%.
So the implication is crystal clear. Returns in 2026 can't rely on investors simply getting more excited and pushing that multiple even further. They have to come from genuine earnings delivery. The narrative has to shift from valuation euphoria to earnings reality.
So if the U.S. market is trading at a premium that high, where can investors find more sensible valuations globally? This sounds like the perfect time to diversify.
It absolutely is. The opportunities are outside the U.S. megacap winners. The reports highlight that the U.K., Europe, and emerging markets are all trading at more modest premiums relative to their own long-run averages, and importantly, at deep historical discounts relative to the U.S.
Really?
UK equities specifically are trading at one of their widest valuation discounts to global peers in the last 2 decades. For the listener looking for value, this is where the reports are pointing.
Okay, let's deep dive into the U.S. economic picture for 2026. It's still the engine of the global economy. What are the core forecasts for next year?
So analysts are penciling in U.S. GDP growth moderating to about 2%. CPI inflation is forecast to remain sticky at 3%, again, still above the Fed's target. And unemployment is expected to tick up slightly to 4.2%. But beneath those headline numbers, there's a structural issue that really complicates consumption, what they call the K-shaped economy.
We hear that term a lot, but how is it impacting the financial reports right now?
It means we have 2 completely distinct consumption dynamics going on. The data shows that the wealthiest 20% of U.S. households are responsible for roughly 2/3 of all personal spending. They're healthy, cash-rich, and driving the high-end sectors.
Right.
But then, lower down the income ladder, consumption is strained. Those COVID-19 excess savings are pretty much depleted. Analysts argue this 2-tiered consumption-driven economy is unsustainable unless real wage growth accelerates significantly for the struggling 80%.
And that ties directly back into government debt pressure, doesn't it?
Right.
If the government is stepping in to support that lower half, the costs are just immense.
They are staggering. The U.S. government is now spending $1 trillion a year just on net interest payments. That money is totally unproductive. And here's the fiscal time bomb for 2026. Nearly 1/3 of the entire national debt is due to be refinanced in the coming year.
1/3. Wow.
When you have to roll over that much debt at higher prevailing rates, every single basis point the Fed moves or doesn't move matters immensely to the fiscal stability of the country.
So the Fed has very little margin for error. The analysts are penciling in a couple of interest rate cuts. Is that a consensus, or is there major risk to that forecast?
There is definite risk. While cuts are currently forecast, there is documented dissent among federal open market committee members. Some are still deeply focused on the resilient labor market, while others worry about, geopolitical risk or clarity on tariffs reigniting inflation, which would instantly stop any cutting cycle.
So what does this environment mean for China? Because they have their own transition struggles going on.
Oh, China is performing an extraordinarily difficult balancing act. Their GDP growth is forecast to keep moderating down to about 4% in 2026. Their big challenge is deflationary pressure.
Right, the opposite of the U.S.
Exactly. CPI inflation is expected to rise to only 0.8% in 2026 after being basically flat in 2025. This points to continued overcapacity in their industrial base and really weak domestic consumer demand. Beijing is trying to shift the country away from its historical reliance on property and exports and toward green technology, AI, and domestic consumption. But that last part is really hard. Consumption as a share of GDP was only 40% in 2024 compared to 70% in the U.S. This requires a massive and probably painful structural change.
And yet, despite all these internal struggles, China holds significant geopolitical leverage, particularly when it affects U.S. tech and defense supply chains.
Absolutely. The reports all highlight the persistent leverage China holds through its dominance in rare earth elements. These are vital for U.S. high-tech, defense, EV production, and China controls an estimated 70% of global production.
And they've used it before.
They used this leverage in 2025 by tightening exports in response to tariffs, and while trade deals temporarily suspended those restrictions, the fundamental reality is that building an alternative, stable Western supply chain will take years. This leverage persists right through 2026 and beyond.
Okay, we've spent a lot of time on risks, which are short-term and cyclical. But the real money in investing is often made on these multi-year structural trends. Let's look beyond the noise of the two revolutions the reports highlight, starting with the electrotech revolution. What defines this?
This is a fundamental multi-decade shift. It's the global economy graduating from reliance on, extracting finite fossil fuels to harnessing virtually limitless electrons. It's driven by physics, economics, and security.
How so?
Electrons are just more efficient, solar costs are falling relentlessly by 16 to 18% for every doubling of deployment, and the electricity supply becomes geographically dispersed and thus more secure.
And the reports organize this whole revolution around three interlocking shifts: supply, demand, and connectivity. Give us the breakdown.
Okay, so on the supply side, the transition is really mature. Clean energy, solar and wind, is now the undisputed cheapest source of new electricity in almost every major market globally. In 2024, solar additions alone exceeded coal, gas, and nuclear combined. On the demand side, the surge is just universal. Electrification is happening across multiple sectors. Global electric vehicle sales were up 35% in 2024, but the most powerful demand surge comes from AI.
I was going to ask about that.
Data centers are projected to consume nearly 4% of global electricity by 2030. That is a massive strain on existing grids.
4% of global electricity just for data centers. That's immense. How does the grid even manage that without blackouts? I guess that's where connectivity comes in.
Precisely. Connectivity is the enabling infrastructure. So battery energy storage system capacity, or BES, more than doubled in 2024, a 113% rise. These systems, coupled with smart grids, are essential for integrating variable supply like solar and wind with soaring demand from AI and EVs in real time.
So for the listener, how do you invest in this? Is this about buying utility companies or more specialized component manufacturers?
The report suggests value creation flows in two main ways. In the medium term, it flows to companies that master low cost, flexible power, and efficiently reposition their core operations around electrons. But the long-term durable investment is in the structural enablers, the companies building the grids, the storage infrastructure, the rare earth processing, and the digital networks that optimize the whole system.
Let's pivot to the other major structural shift, the maturation of cryptocurrencies, focusing on those seismic regulatory changes in the U.S. during 2025. This was dubbed the Great Reversal.
It was a true reversal. For years, U.S. regulation was hostile, particularly toward the banks. That all changed in 2025. It began when the SEC rescinded Staff Accounting Bulletin 121, or SAB 121.
And what was the practical impact of getting rid of SAB 121?
SAB 121 basically made it prohibitively expensive and risky for large U.S. banks to custody digital assets. By rescinding it, the SEC cleared the path. This move was then echoed by the OCC and the Federal Reserve, which resulted in a unified permissive stance from all key federal banking regulators for the first time.
The blockade was removed.
The banking blockade was removed. Furthermore, the persistent legal ambiguity that plagued the industry was resolved. The SEC dismissed key lawsuits against major players like Coinbase and Ripple, and the whole thing was sort of cemented with the signing of the Genius Act in July, which provided the first clear federal framework for stablecoins. This signals that the industry has officially moved from regulatory risk to regulatory reality.
So now that Bitcoin is arguably mainstreamed and regulated, the question becomes, how risky is it actually? Has the volatility come down?
It has diminished, which does suggest maturity, but it's still extreme. If we look across the past halving periods, annualized volatility has steadily fallen from a massive 111% in the first period to a still high 47% in the most recent one.
But the more critical question for a portfolio is correlation. Does Bitcoin still act as a reliable diversifier? Does it move opposite to or independently of stocks when the market tanks?
The data suggests not reliably. We see what the sources call a classic risk-on profile. In low volatility regimes, Bitcoin's correlation with equities is modest, around 0.26. But the moment volatility spikes, when investors are panicking and you need protection, that correlation jumps sharply to 0.47.
So it falls when everything else is falling.
It increasingly behaves like a conventional risk-on asset. It may not offer you that reliable diversification right when you need it most.
And anyone getting into the market still needs the stomach for extreme volatility.
Absolutely. You have to budget for the possibility of these extreme crypto winters. Historical drawdowns have repeatedly exceeded 70%, with recovery periods taking as long as 38 months just to get back to the previous peak. It's a high-risk asset that demands extraordinary patience and long-term conviction.
Now, wrapping up with fixed income and private markets, where can investors find some durable value outside of stretched equities and high-risk cryptos? Let's decode the bond market first.
The outlook for the bond market is pretty constructive for 2026. The simple reason is that yields, both nominal and real, or the yield after inflation, are well above their 20-year averages. That's a strong starting point, and declining policy rates typically provide a performance tailwind. The strategy, though, has to focus on quality and medium duration. We need to prioritize BBB and BB-rated medium-term bonds. Why? Because the ultra-tight spreads on lower-quality debt are likely to be tested by a wave of refinance. Many high-yield issuers locked in 5-year debt at those ultra-low post-pandemic rates, and now they have to roll that debt over at much higher current rates in 2026. That creates significant default risk for low-quality issuers, making quality paramount.
And finally, private markets. Deal activity really stalled in 2025. Is 2026 the year that reverses? And what's the strategy there?
Private markets are definitely positioning for a buyer's market. The stalled activity cleared out a lot of excess capital. And crucially, managers can no longer just rely on cheap debt and financial engineering for returns. The strategy is shifting entirely toward active value creation, meaning improving margins, driving digital transformation, and leveraging AI for genuine productivity gains within the portfolio companies. The best opportunities are likely to be found in mid-market buyouts, which offer more attractive valuations than the crowded large-cap space, and in secondary market transactions, where limited partners, the big institutional investors, are seeking liquidity after the slowdown, selling their fund stakes at a discount.
Okay, so as we synthesize everything, the tight valuations, the macro headwinds, the structural opportunities, what are the three defining principles for you to adopt for investment success in 2026?
The sources really boil it down to three priorities. First, diversification to reduce that concentration risk and broaden opportunity beyond those narrow AI winners. Second, quality and income, anchoring portfolios in durable, cash-generative businesses that can withstand economic shocks. And third, structural exposure, making sure you capture the next waves of innovation like the electrotech revolution.
So 2026 is clearly a year for rebalancing, for selectivity, and for vigilance, not widespread exuberance. You have to interpret every data point carefully and critically. So here's our final provocative thought for you to chew on. If U.S. equity markets are trading 40% above their long-term average, driven primarily by valuation expansion, what specific piece of incoming economic data, not a war, not a surprise election, but a single piece of incoming data related to inflation, employment, or consumption could immediately force the market to shift its focus back to the relatively modest 5% corporate earnings growth rate? Finding the answer to that question is the interpretation game you must master in the coming year.